Good evening, my friends. I am going to cover adjusting entries, deferral, and accrual entries, which we'll start with deferral adjusting entries. These are our two types, um, deferral and accrual adjusting entries. That includes depreciation entries at the end of a month, and I am going to quickly get into these. We're going to be in the deferral area at first here. I'm going to give you a transaction that occurred at some point, and then we'll do the adjusting entry. If you've heard of the month-end close process, or heard of someone or a friend or someone that you know, a friend's parent or your parents that does the close, the monthly close for a company in the accounting and finance department, that is finishing the records. The accounting records of the company so that you can publish financial statements. If I could show us a quick map here, this is a good portrayal of the process that we're on here. We've had journal entries and transactions happened all month. We've created and posted those journal entries, and we now have to do the adjusting entries to get to an adjusted trial balance to issue financial statements. Once we finish all of our adjustments and close the accounting records of a company, we can publish these financial statements. In video 2, in my prior video, I created an income statement, a statement of retained earnings, and a balance sheet from scattered adjusted trial balance data. Now I'm going to focus on adjusting entries here. I'm going to give you the transaction. This is not an adjusting entry, but we'll adjust it after I show you the entries. So on December 27th, 2018, Sunshine Corp pays their insurance company $18,000 for a six-month premium starting January 1, 2019. So this is not the adjusting entry. This is a transaction. We paid the insurance company for a future policy that's going to start in 4 or 5 days. So on 12/27/2018, let's record this journal entry. We are going to debit prepaid insurance, which is an asset, and we're going to credit cash. This transaction, again, is not the adjusting entry. I want to ask you, what's the first date we need to adjust this prepaid insurance? I'm going to create a T account to represent its general ledger account, because I know you guys will be excited about that. And then we'll create a little T account to represent the general ledger. So we start the new year. The answer to my question is that January 31st is going to be the first day we need to adjust this. Why? Because we have now used 1 month of the policy. 1 month of the policy has expired and been used by Sunshine Corporation. So for Sunshine Corporation's record, here we are. Here's the adjusting entry. It's going to be 01/31/2018. How much is my monthly depreciation? 18,000 divided by 6. There's my monthly depreciation, or excuse me, my monthly amount that I need to move over to expense. So I'm going to go debit insurance expense, which is on the income statement, for $3,000. And I'm going to credit prepaid insurance. It's not prepaid anymore. We've used it. 1/6 of the policy has expired, therefore 1/6 of its cost needs to be expensed into January. So prepaid rent, if I change the example to say we paid January, February, and March's rent of $18,000, so 3 months of rent on December 27th, you'd now be having to move $6,000 of it over from prepaid rent to rent expense. Prepaid rent and prepaid insurance are two good common types of prepaids. There we go. That's a deferral entry. And then I'm going to come back here. Let's see, I just need to get some. Let's do depreciation. On January 1st, 2019, sound company buys a $50,000 piece of equipment for their for their company. They pay cash and put it into service immediately. It has a 5-year useful life. So they believe this piece of equipment is going to last for 5 years. And then they'll have to buy a new one because it will wear out. So this January 1st entry is not an adjusting entry. It's just a financial transaction. We're going to debit equipment, and we're going to credit cash, $50,000 and $50,000. So what do we have here? We need to depreciate this asset. I'm going to show you. A lot of publishers like to show you annual depreciation. That's fine. A lot of textbooks is what I mean by publishers, but depreciation has to be recorded monthly, not annually. It can be trued up and perfected on an annual basis to make sure everything was correct in the year, but this should be being done on a monthly basis. If I were to find the monthly depreciation, oh, and I need to make one more note. We assume for this example a 0 residual value or salvage value. We don't deal with salvage value in the 3 depreciation methods until a later video, but monthly depreciation, there's 60 months in a year, so we'd have 833, and then for annual depreciation, of course, we have 10,000. So I'll show you both. I'll show you both just to make sure we're perfectly accurate. The same question applies here. What's the first date we are going to have an adjusting entry? The first date we're going to have an adjusting entry is on January 31st. Why? Because 1/60th or 1 out of the 60 months of the use of this equipment has been used. If we were doing the annual entry, we'd be saying December 31st would be the first date for an entry, but again, that is technically incorrect. We're going to book depreciation entries if we're doing US GAAP accounting on a monthly basis, which is why I don't like how the publishers frame it through an annual window, but must be for the ease of numbers or sake of examples. So I'm going to do the monthly. This is an adjusting entry. I'm going to debit depreciation expense for this equipment, and I'm going to credit accumulated depreciation. I've got to move this entry over, so I'll bump this over too real quick. So this depreciation entry is going to be, let's see here. Let me see here. Yeah, we're gonna do a monthly first. Accumulated depreciation equipment is a contra asset. It's presented on the balance sheet as equipment will always stay. Equipment will always be at this 50,000 for this item, and then the accumulated depreciation portion, I'm going to say less accumulated depreciation. And right now, after 1 month, we've only used we've only expensed to depreciation expense $833. So our accounting value or our net book value for this asset on our balance sheet would be $49,167. I don't want to go too far on this tangent, but it would be unfair to the month of January 2019 if we expensed to the income statement all of this $50,000. And the reason is because we're going to use this thing for 5 years, and we're going to share the cost or distribute the cost or allocate the cost over all 60 months, in this case, equally. So the logic behind this is that every month in that 60-month period that this equipment is going to be in service or being used to generate revenues and operate the business, we are going to make a depreciation entry for it. And 1/60th of the cost we are going to move to the income statement. Every month that this transaction happens, this is going to increase, lowering the net book value or accounting value of this asset until it gets to zero, because we assumed that we couldn't salvage it for anything, meaning we're just going to take it to the dump when it's done. No one even wants to buy it for parts, is assumed in that for this piece of equipment. So that's the logic behind depreciation in general. And we cover depreciation in more detail, but I hope that will help give context to what we're doing. What is this account? When we did the original transaction, we bought this, we put it to an asset account. This is a property, plant, and equipment asset on the balance sheet. The classified balance sheet, as you know, has 4 types of assets. This is a property, plant, and equipment classification, and we're going to depreciate it over its useful life. That depreciation is to expense a portion of that equipment over its useful life rather than charging it to one individual month, which would be unfair to that month and inconsistent in our accounting records to do it that way. That's why we do it. There we go. Okay. On August 28th, 2018, the Utah Jazz or no, let me actually change that. 28. Sandhill Corporation buys $50,000 of season tickets for a 10-game package. No, let's not do this. I'm going to start over. Let me start over. Sandhill IT Services receives a cash payment from customer Utah Jazz with an S. So I don't copy. No, just kidding. Utah Jazz will work. For IT services starting January 1, 2019 through December 31st, 2019. The payment is for the entire year and is $240,000. Sandhill IT Services just received a huge payment from the Utah Jazz for IT services. And it's for the 2019 year. They're making a serious prepayment. This is a little bit of an exaggeration. They're really prepaying this like 4 or 5 months early. This transaction on 8/28/2018 is not an adjusting entry. It's the normal transaction, the normal journal entry for this financial transaction between Utah Jazz and Sandhill. Sandhill is going to debit cash for $240,000, and they're going to credit unearned revenue. They're going to credit unearned revenue for the other person. What's unearned revenue? Man, the word revenue screams out that this is an income statement account because revenues minus expenses equals net income. We'll stop right there. Unearned revenue is unearned, meaning it's not yet recordable as a revenue. Why isn't this revenue yet for Sandhill? Because they haven't earned it. They haven't performed the services, the IT services they've contracted to in January, February, March, on and on, the 12 months of 2019 where this contract runs. I'm going to do some basic calculus here. $20,000 a month, 12 months to 240 divided by the 12 months is $20,000 per month of is the cost of this contract. So when is the first date that Sandhill will have earned revenue? You guessed it. It's January 31st, 2019. Because now accounting periods are monthly, quarterly, and yearly. So while we could be making these changes during the month, we're illustrating this through, or we're not going to make a daily journal entry recognizing the daily revenue we've earned. We're going to wait till the end of the month and make this adjusting entry. That's why we do adjusting entries. So I'm going to debit unearned revenue because I'm going to reduce it. We reduce a liability by debiting it, and of course we increase it by crediting it, as I did here. Unearned revenue, and I'm going to credit IT service revenue. We've earned how much of this contract? We've earned $20,000. We increase revenue with a credit. By now, you should be comfortable with what increases account and what decreases an account. Assets and expenses are increased by a debit. Liabilities, owner's equity, and revenue are increased by a credit. And then we can default into what decreases them from there. What have we done here? We received a payment that wasn't yet earned as Sandhill. We recorded as such. We owe the Utah Jazz until we provide the services to them. And the first month that we provided the services, we recorded $20,000 of revenue, and we reduced unearned revenue. What's the balance in unearned revenue right now? That's the question I have for you. The balance is we started with 240, and then we made this adjustment, right? So this is December, or no, this was a August payment, right? And then here's 01/31/2019, the first month in which we used it. So the balance would be 220 as a credit. So the balance sheet would show $220,000 of unearned revenue as a liability at January 31st. How much would it show at April 30th after we do our adjusting entry? Well, we would have had 4 of these months, January, February, March, and April. So the balance would be now 240 minus 20 minus 20 minus 20 minus 20. The balance at April 30th after the adjusting entry would be $160,000 is remaining in unearned revenue. $160,000 is the amount that we have not provided yet to the Jazz because the time and the services haven't been provided for any of the months after April. Let's do a quick expense. I'll make it as simple as possible. Let's assume we're closing the books for January 31st, 2019. On February 3rd or February 6th, Sally, staff accountant, finds a utility invoice for January utilities that has not yet been recorded in the system, recorded in the accounting software. It's $500, or no, let's do $5,000. It's $5,000. So what am I gonna do? Am I gonna record this on February 6th when she found it? The answer is no. We're gonna record this because it's a January item. It says it's for January. Let's be very clear so no one can be nitpicky with me. It's for January 2019 utilities. I'm gonna debit utilities expense, and I'm gonna credit accounts payable. So I'm making sure that this entry gets in our books that we owe the utility company $5,000, even though it had failed to be recorded and hadn't been caught yet. Utilities. Okay. That's an example of an accrual entry. The same thing could be found with revenue. Let's say we're a smaller business and I go to the owner and he tells me, hey, I actually delivered product, or I completed some services for someone and I have not yet told the accounting department. Let's say we're only a 5-person group, so everybody wears a lot of hats. So we find out on February 7th that owner John Doe completed $8,000 of custom IT services for a new customer. They were completed on completed in the month of January and have not yet been billed to the customer. This is very similar. We're going to book this entry as an adjusting entry on the 31st of the month because it was completed in January. We're going to debit accounts receivable because this customer now owes us $8,000 because the owner had completed the custom job, and we're going to credit IT service revenue because we need to record revenue in the month of January that was completed and performed in the month of January. So these are two good accrual entries right here. And I'm going to scroll down this one more time. Deferral and accrual. We started with deferral entries. We did prepaid insurance. We did a depreciation entry. And we did an unearned revenue entry. Okay. And then we did 2 accrual entries, one where we had an expense that had not yet been recorded, and one where we had a revenue that had not yet been recorded. So we made sure that those got into them, that the accounting records included those through these adjusting journal entries. Why do we do this? If our financial transactions are good and we complete all of our adjusting entries, then we have this opportunity to provide great value. Oh, I'm in the wrong slide deck. Give me 1 second. We provide great value by publishing good financial statements. Garbage in, garbage out. If our journal entries are garbage, our trial balance is going to be garbage. If our adjusting entries are garbage, our adjusted trial balance is going to be garbage, and our financial statements are going to be garbage. This is garbage in, garbage out. If you have some bad strings of code and you're a programmer, and it's deep embedded into your product, then you've got problems on your hands. Knowing the truth about financial transactions and following the accounting rules, US GAAP, we can produce quality financial statements that can be used internally and externally. The IRS wants your financial statements through your taxes. Banks, if you borrow money from them, will want to have good US GAAP financial statements. If people invest in your company, they're going to want to see financial statements so they can track your performance. And any owner, manager, director of a company is going to want to be involved in knowing that we have good numbers and good data to compare this January to last January. What's the year-over-year comparison? If we have bad financial transaction, bad adjusting entries, and a crappy close process, well, we're going to have bad financial statements. All right, that concludes adjusting entries. I kept it under a half an hour. I hope that was helpful. Signing off. Have a good night.